everyone. I am Hannah Andrea Elobon from BA Centrim 2A, and today I will discuss to you about leverage.
So, what is leverage? In finance, leverage is any technique involving using debt or borrowed funds rather than fresh equity in the purchase of an asset, with the expectation that the after tax profit to equity holders from the transaction will exceed the borrowing cost frequently by several multiples. So that is the definition of leverage. When one refers to a company, property, investment as highly leveraged, it means that items has more debt than equity. So how does financial leverage, operational leverage, and total leverage related to the income statement? Operating leverage is concerned with the relationship between sales and operating profits, while the financial leverage is concerned about the relationship between profits and earnings per share. And lastly, the total leverage is concerned about sales and earnings. So that is how leverage functions in the income statement. My answer for the question number 2 is the break-even quantity of sales, or just simply break-even point, indicates the number of units of a company's product that is produced and sold, at which point the company's net income becomes zero. So this is referred to as the operating break-even point or operating break-even quantity of sales. The total cost of a business is composed of fixed cost and variable cost after the marginal cost of production only if variable cost exists. So the marginal cost of production is calculated by dividing the change into the total cost by 1 unit change in the production output level. So that is the answer for the question number 2. What is operating leverage? Operating leverage is a cost accounting formula that measures the degree to which a firm or project can increase operating income by which increasing revenue. And what causes operating leverage? Operating leverage occurs when a company has fixed costs that has be met regardless on sales volume. When the firm has fixed costs, the percentage change in profits due to changes in sales in volume is greater than the percentage change in sales. So, the degree of operating leverage can be calculated by subtracting the variable cost of sales and dividing the numbers by sales minus variable cost and fixed costs. So, what is financial leverage? Financial leverage, is also known as the leverage or trading on equity, refers to the use of debt to acquire additional asset. The use of financial leverage to control a greater amount of asset by borrowing money will cause the returns on the owner's cash investment to be amplified. So, how to measure the degree of financial leverage? Degree of financial leverage is a measure that assesses how sensitive a company's net income is to a change in the company's operating income. It is calculated by dividing percentage change in earnings per share by percentage change in earnings before interest and taxes. An increase in the value of the assets will result in a larger gain on the owner's cash when the loan interest rate is less than the rate of increase in the asset's value. So, we're done discussing about the leverage. That's all, and thank you. God bless everyone.